Hello, this is Peter Bell, and I'm here with Mr. Brett Heath from Metalla Royalty. Hello, Brett.
Hey, Peter, how are you?
Very well, thanks. And first time talking to you, very excited. The list of names and faces on the leadership slide in the corporate presentation is great, super who's who of Howe Street. Before we get into all that, maybe one question, kind of blue sky thinking about what your business does and all that. The secondary market for royalties on mining projects in development stage, and the secondary market for those kinds of royalties versus the origination markets. I was thinking about these phrases and these words. They're not really things that I had thought of before being exposed to your company, but very interesting niche areas of the junior mining sector. I would imagine information is pretty scarce in that space, and relationships are absolutely essential for access to deals and everything else that goes along with it. So just to maybe put that to you for a second to start off.
Sure, sure. So, just for your listeners, to back it up really quick, we're a royalty and streaming company. So we don't operate any mines, we don't do any drilling, we don't have to engage in expensive capital expenditures for a number of different issues that typically mining companies have. We own small non-controlling interests, and those are usually in the form of either a royalty or a stream. And both are similar in nature. A royalty is just a percentage of production, and a stream is the right to buy a percentage of production at usually a below market price. So there's a kind of a guaranteed margin, if you will, in these metal purchase agreements. And historically, they've just been, this model in general has been really just an incredible way to get exposure to upside, upside leverage in precious metals and other metals. But we're a precious metal based company, along with some of the larger companies in the space that some of your listeners may be well aware of, like the Franco-Nevadas and the Wheaton Precious and the Royal Golds. These are multi-billion-dollar companies, and actually some of the biggest companies in the space. And it just is, a great, path for us to follow here, and kind of on a proven strategy to be able to grow this company and kind of be part of the true kind of growth businesses, in the mining space. And we can go through, obviously a number and get into a number of kind of the benefits of, the royalty model compared to kind of getting exposure to the mining model. But I think that would be a good overview of, just our business in general. Now,
Thank you, Brett. Yep.
No problem. So now Metalla itself is a bit different, and what we've seen in the sector over the last call it about the last 5-6 years or so is that it's become actually extremely competitive at the high end. And when I say the high end, I mean transactions normally north of about $100 million. And the reason why is that through this latest downturn, we saw the royalty, or at least the large royalty and streaming companies, really step in and fill the gap of what the senior lenders used to do. The senior lenders, a lot of them left the space in the 08-09 crash, and in the last downturn, it allowed the royalty and streaming companies to really increase their transactional size and do bigger and bigger deals. And the larger deals that are around require bigger projects, and obviously the bigger projects, there fewer are. So you had a lot more people, you had private equity funds, you had other groups with significantly deep pockets kind of come in all at once, fighting over these bigger deals. And what that did was it drove the returns down at the high end, but it also had somewhat of a reverse effect for transactions, call it around less than 20 million in kind of ticket size.
Yep.
Mostly because the critical mass issues that the bigger guys had, they need to have kind of a more material transaction to impact their portfolio. So we saw this opportunity and we wanted to capitalize on it. Now, the second part of, as you noted, in regards to our model, which is, more of a focus on the secondary market, was purely a factor because we knew that, in order to get the premiums, the whole point of the royalty and streaming game is to obviously get the premiums in the public markets that the bigger guys trade at, right? These are very, very, very healthy multiples in bad markets of, mid-20s for the big guys and high teens for the kind of smaller mid-tier players, multiples of operating cash flow compared to what the mining companies get, which is, probably, mid to high single digits. So a pretty significant gap in kind of valuation. And that's really what we're after. And in order to get that, we knew we needed to get exposure to some of these larger counterparties, right? The market really doesn't trust most of the junior mining companies, and the reality of it, and a lot of this is based off experience, is that, if you write a number of streams on junior mining companies, it's not really a scalable business because it ends up being so much more time consuming. And it's nothing against the junior mining companies. It's just they don't have the balance sheets, they don't have the personnel, they don't have the skill sets kind of required to really push these projects forward successfully, right? I mean, you get a geologist that makes a discovery that kind of bootstraps his way into, a small project, and they want to toll mill it down the road, and it's just a number of different factors and risks that kind of go in that. So understanding that we wanted to get exposure to the larger operators, there was really only one way for us to do it, because they're not going to take checks from us, less than 20 million. They need, checks that are, more along the lines of $500 million to really make a material difference for them. And that put us into the secondary market. And, what we found was that, first off, at any given time, there were a lot more opportunities in the secondary market than there were in, call it, the new origination market. The new origination market is always dependent on kind of timing on these projects, when they're ready and when kind of the studies have been done and, they're ready to go, they've seen their BFS or their PFS, and, the capital sources out there can kind of get comfortable. The secondary market is a bit different, right? And it's every single time a project is kind of bought and sold or discovered or down the line, normally there's royalties that are retained, and there's royalties everywhere on tons of projects. And what we found out was that a lot of these royalties were being held in somewhat convoluted structures where they weren't getting really the full value. The holders, the third-party holders of these royalties, weren't getting the full value for them. And so as part of our business model, we wanted to really give these holders a vehicle to be able to monetize that. And in turn, in exchange for that, our shareholders and our investors that finance these deals get exposure to some of the top operators and some of the best assets in the world as a small high growth company, which is just an excellent combination, because normally you're not going to get exposure to the Pan Americans and the Gold Corps and the Agnicos, and you're not going to get exposure to these companies without buying their mining companies, which are multi-billion-dollar companies. And in order for them to grow is much more difficult, just given their size. And so, we focused on this, and another part of kind of the model that really, works, and, you can see that, specifically visually, if you want to look on on page 6 of our deck. And this just goes over kind of an overview. We've only been around for a little less than 2 years now. So, you know, I'd say still fairly new, especially to the royalty and streaming space. But,
Yeah.
you know, if you look at this chart and you look at this page, you know, what you see here is we've done transactions with private equity funds, with exploration companies, with private individuals, with major mining companies, kind of across the board here. And, you know, the common denominator for all of these companies is the same thing. They're not getting the value that they believe in the royalty that they hold. And so we give them a very, very clear way to not only get that value, but also own it through a much better price discovery mechanism, which is Metalla equity. And
Yep.
every single deal that we bring in immediately has this revaluation event when you go from holding it in an exploration company to holding it into a pure play royalty and streaming company, or a major mining company to a royalty and streaming company as well. So,
Well, and to interrupt you for a second there,
yeah.
I see Coeur with 19.5% of the share ownership, and then also this, you know, Metalla acquires royalty and streaming portfolio from Coeur Mining. That, you know, I don't know if that counts as an origination transaction or a secondary market or what that is, but that's a great deal that brought them in as a strategic investor in the company as well, stacking up some inventory and, you know, lining yourself up there.
Yeah, exactly. And look, the reason is it was a really great deal for Coeur, and it was a really great deal for us. You know, Coeur had a portfolio of non-core royalties and streams that they were getting no value for. And they were getting no value because they're a mining company and they've got multiple mining operations, and that's why, or what they're valued off of in the market. Yet they had something, you know, that was worth a lot, and they weren't getting it. So they didn't want to, you know, they understood this clearly. And so their position was, look, we need a place to put this.
Yep.
You guys have proven yourself as a management team that can execute and grow and make this a lot bigger. So we would like to do, you know, a transaction. And so, you know, we did a deal where we acquired 4 assets from Coeur Mining, and the deal was 100% paper broken up into equity, which is the 19% ownership that you see on there, and then also a convertible debenture that maintains that 19.9. So
Yep.
it worked out great because from our standpoint, we get an incredible strategic shareholder. We get you know, a multiple asset transaction. We get, you know, obviously growth in our company, but more importantly, the cost of capital to raise the $13 million US that we acquired that for was essentially zero for us, right? You know, if junior companies go to the market, that they're typically paying, you know, full warrants plus, you know, plus a banking fee on the equity side, or you know, debt is likely to be in the high teens, right? So it's just kind of another factor to the model that allows us to really compete and excel in the area that we're interested in excelling in. And you know, I think you see all the royalty and streaming companies doing this now. I think all of them are now a bit more frustrated in regards to kind of what some of the returns have been on you know, on any group of assets, especially if there's any bidding process involved. And you know, it seems to me that they're all kind of figuring out their same you know, or different ways to be able to get better returns. Like Wheaton Precious has their early deposit. You know, Cisco's got their accelerator model. You know, Sandstorm's doing their own thing that is also similar and also sounds, you know, and they've proven, you know, most of these companies have proven that you know, have found different ways to be able to kind of create better returns. And I think you have to. I think you definitely have to. And you know, we've carved out something with Metalla that is, you know, highly scalable and we think we're going to be able to continue on this path for some time. And as of right now, there's not a lot of there's not a lot of royalty and streaming companies sub $1 billion market cap. So it's a pretty unique opportunity for investors to get exposure to not only a young but a growing and a kind of a company with a proven strategy. In the early days, right?
I
Any.
I
Go
I
ahead.
hold out hope that that this particular niche could be one of the most voracious of the whatever the next bull market run looks like. The takeover space for small royalty companies. I feel like that could get to be really hot.
Yeah, and that's what we've seen in the past. You kind of hit the nail right on the head there. And what happens, historically at least, in this space is when precious metals rise and we get further into, call it a new bull market, equity seems to return to mining companies and becomes a bit less expensive in regards to a cost of capital than typically what the streaming royalty companies have had to offer. And so what you see is the deal flow normally for the bigger companies dry up pretty quick, because most of the bigger companies, their core part of their business model is really the traditional streaming and royalty model, and that is providing project funding for an exchange for a royalty or a stream. So the cycle time on that is normally only, call it 2 or 3 years in regards to kind of making the investment and getting the mine built. And after that's done, most of these companies are going to have a hard time reaching for growth. And when that happens, what we've seen in the past is they kind of look downstream and they say, look, this company is trading at this multiple. We've got a much higher multiple, and it's a creative deal to get some good growth. So that's kind of the reason why there's only call it around 10 or a little bit less than 10 kind of real royalty and streaming companies in the precious metal side out there.
And a question about the Coeur deal again. Do you care to say like how quickly or slowly that deal might have happened?
What I can say is that I can only obviously speak to our strategy here in general. But what I can say is that what's different about Metalla is that we, especially focusing on the third-party market, we kind of understand and know the majority of the assets that we want, and it's more of an exercise of maintaining those relationships for years and years and years, and a lot of them go back a decade even before Metalla was even started, and waiting for the right timing for those to line up. And that's really the way that you can pick up these great assets. You got to have the relationships, and if you don't have the relationships in the space, then you're likely not to get any of the more lucrative deals that are available.
It sounds like the deal might have happened very quickly after a long time in a way there. And one other kind of random question for you: Triple Flag Mining Finance. Cayman, I think. Sorry, but do you know them at all? Like, it's a private group that I encountered. They bought a silver stream from Centerra for the Kemess mine in British Columbia, a big porphyry.
Yeah, so kind of what I mentioned a bit earlier in regards to the competition in the space becoming significantly more than kind of what it was 5 and definitely 10 years ago. There's a number of these private, look, the model is a great model, and it doesn't surprise me that the private equity funds also want a piece of it. and there's there's a number of shops that have made attempts to kind of get into the market. Some have been a little bit more successful than others. But it just kind of goes again into what we're looking at the high end, and kind of why the bigger companies are looking to find ways to kind of recreate themselves to be able to get better deals, because you've got these private equity funds that kind of come in there, and what all these companies are doing. I mean, that was I can't remember specifically, but I believe kind of the whole transaction was around $200 million. These are competitive bids.
Yep.
These are very, very, very competitive bids, and I think it was obviously a great deal for Centerra there. But there's just not a lot of these assets out there. So
But with
you seem to.
securitization too, if you get it into the private guy's hands, who knows what kind of derivative stuff they could chop it up into for, OTC markets out there all over the world, right?
Yeah, I mean, I would I would say that that's probably not a part of the market that we are really interested in going after.
Good. Yeah.
And mainly that is because the returns just really aren't attractive for our shareholder base. They
Yep.
they kind of require a bit more of a return than what has been seen lately in the space on transactions of that size.
Well, and being a public company, it gives you all kinds of other things to do in the public markets, like this VALGOLD deal that here in March 2018 recently. I see Osisko has a resource update pending for July 2018 scheduled. That's super exciting. And reading that the 2013 report was talking about 125,000 ounces of gold per year. Talking about a 2% NSR on that is upwards of 2,000 ounces of gold per year, to Metalla attributable if and when that thing goes into production at that scale. I'm sure it has potential to grow and all that good stuff. The one thing I didn't see about Val was a possible cost number for you guys. Is it a share acquisition, or what's the deal there?
Right. So in the press release, it was an all-share deal valued at $7.2 million Canadian.
Wow.
And look, it was kind of one of those situations where exactly what I explained to you in the beginning, right? You have an exploration company holding a royalty and getting very little value for it. We can work out deals for these types of transactions because there's enough value discrepancy where we can give the shareholders of that company a very, very healthy premium, yet it's still very accretive for Metalla shareholders once the transaction's closed. And going back to kind of again, owning the assets that we think are going to drive the highest premiums in the market. This is a tier one jurisdiction. If Osisko doesn't build it, then we think it's likely that another mid-tier or major comes in and does build it. It's got one of the best addresses you can have as a mining operation. Great infrastructure, and it's likely to be a bigger project. Osisko did put another 85,000 meters of drilling into the ground on this thing, and I think there's not a lot of these projects out there. So we're going to look for ways to first and foremost add value to our shareholders on a per share basis, and sometimes we are going to look at these development projects that we think have quite a bit of legs here in the future in order to get a better valuation on them rather than what typically something like this would cost if it was already in production, right?
Yeah. And thank you for having such a great presentation deck. To see your portfolio producing, your portfolio development and exploration, all of that just really speaks to, you guys have the show on the road here. 3 producing royalties is very impressive. Is it more than that, or is it just 3?
Yeah, so I mean, mainly the majority of our production comes from 2 assets, which is the Endeavor mine and the new Louika gold mine. The ZARUMA mine still needs a bit of work to do. They had a new team in there. We have received a bit of income there, but most of it was tied to past royalty payments. So they still have a little more work cut out for them on core gold on the ZARUMA mine, but again, it was something that we were able to acquire at a great price, and we think reflected kind of the risk around it, and we're happy to do that all day long. And in regards to our development portfolio as of today, the first asset that will be producing for us is going to be the JOAQUIN project, which Pan American has given guidance that it would be in production by the end of calendar year 2019.
Yep. Well, and where you are right now too, I see a lot of silver, right? It's primarily your revenues from silver, so I'm sure that intrigues some people out there.
Look, this is a really important note, and this wasn't something that we really set out to do. As a company, we don't have a bias towards gold or silver. We think they're both kind of equally valuable. Obviously, silver in bull markets tends to outperform gold, and then also vice versa in bear markets. So there's a bit more leverage with silver, but the important thing to note on that is even the highest pure, the purest silver producers that are out there from the mining companies, they still, they're still only really, call it 60, 70, maybe 80% silver, because a lot of the silver runs with lead and zinc, and that comes out of a lot of their mines. So, in order to get pure exposure to, silver, it's actually a really difficult thing to do. And, we, I think, are, a great way for investors to get leverage, specifically when they're looking to leverage on silver. And, we think silver's got some good times ahead of us. One of the metrics that we follow quite often in this space is the gold to silver ratio, and it's a great metric because it really has nothing to do with the price. And from our perspective, what it shows you is that when the sentiment is really negative, silver always is going to go down further than gold. Gold is much less volatile than silver. And so when you see these ratios, specifically when you see it over 80, that normally means that the sentiment for the precious metal market is not that excited. And it's a pretty contrarian data point where, when you look back the last 20 years or so, you'll see that every single time it's been kind of over 80, there historically has been a pretty substantial run in precious metals, and that's what we're that's what we're aiming to give our shareholders exposure to. $16, $17 silver is extremely cheap for this metal. This, the mining companies, the reality is that they are struggling to make money at this price. It's a really difficult thing to do. So, we think there's lots of good times ahead for potentially silver when that may happen. Your guess is as good as mine, but if the ratio kind of plays out the way it historically has, we could be in for some pretty exciting times over the next 12 to 24 months.
And a question here, maybe kind of off the wall, but just wondering if you've ever thought about like using the proceeds, rolling the NSR cash payments back into the metals. Like if you're talking about, silver at $17, say, and you're getting payments on these two producing royalties, has there been discussion of, taking those cash payments and taking part of them and putting them into silver futures contracts or something like that to get some positive beta back and recapture some of that beta to the metal, so you're not just sitting on cash that you either have to redeploy into royalties right away or distribute to shareholders or
So we do not do that, and just for a couple quick reasons here. First, if our investors want to hedge, then we think they're probably better at it than we are. We want to provide kind of the reason why people buy Metalla is that we're kind of unhedged, and we don't want to pretend to be traders or take metal price risk. We have enough silver. Our leverage is the gold and the silver that's in the ground, right?
Yeah.
And once that's harvest, then we like to do just two things with it. We like to give a little bit of it back to shareholders in the form of a dividend. So you'll notice that we're, as even one of the smallest companies in the space, we're one of the highest yielding companies. And we also like to take some of that back and reinvest into more, accretive, non-dilutive transactions. And, we're very disciplined in doing that. And the reason why we can do that is because, the strategy and the model and the business that we've been able to execute has given us kind of those types of returns that we can bring back to the shareholders. And beyond that, a lot of, as you'll see with Coeur, a lot of the large shareholders are the groups that we do deals with. So it's kind of a full circle type of movement. And, we found that they've been the most responsive that way.
And there's always, to me, the Almadex, Dex, whatever all the names of those things are now, Dwayne Paulquin, Morgan Paulquin, they always seem to have kept some physical bullion in one of their, or their generator, and I wonder, if that's as the treasure capital in Metalla grows over time, that I'll be watching for something like that too. If you guys shift over to some bullion, because your investor base, they would, I'm sure some of them would love to see you keep some of the company capital, cash equivalents in precious metal form physically, but that's a whole other can of worms. So.
Yeah. And I mean, I think the difference there is that, we're cash flow positive, we're paying a dividend, we're still able to, increase our cash balance sheet every month with owning producing assets, right?
Awesome.
Almadex, they've got some great assets. The Polquins I know very well, very high level of respect. I think they're incredibly smart. It's an incredibly smart team and very successful in their own right. But they don't hold anything that's generating cash flow, right? So I think there's kind of a bit more there's a bit more of kind of a liquidity issue that potentially could arise for them.
And back to the original thing that I was asking about, they've come at it from the other side, right? Where it's not secondary markets buying existing royalties. They're all about generation and starting and doing the exploration work and creating those things kind of with the discovery.
Yeah, and look, they're great at it, right? So, I think they're it's definitely a good shop, and a good company. I think where you find the issues is when you find guys that have one way of doing business, let's say similar to the Polquins in generating royalties by the drill bit, and then kind of trying to pivot and do something that we're doing. And we've seen some of the smaller guys run into some pretty not so successful situations by kind of straying away from what their kind of core talent is in running their business.
Well, I look at the list of operators on your exploration portfolio in your deck there, and some of the other places in it too. It just we talked about Coeur, we talked about Osisko, Agnico Eagle, Gold Corp. We can go on and on here. The list of counterparties that you have is quite impressive, I'll say.
Yeah, thank you. And that's the reason is because that's been again a main underlying focus of what we have been trying to do from the start here, and for a specific reason. So that's what you're going to find, and you'll probably see much more of that in the future here going out the next couple of years.
Yeah, it puts you in a really classy kind of spot, right? And there's not a lot of small royalty generators, and one that can have access to all these major players in the industry. Oh wow, that can be a really juicy spot. Because you can potentially move quickly and pick up pieces that other people leave behind and all that good stuff. So great, we'll continue to watch for that. One question that I had waiting for me here was something about guidance for 2018 revenues. Have you guys given any guidance around what that looks like this year, or compared to the past, or what the future looks like 5 years out, stuff like that potentially?
Yeah, so we're actually just firming that up kind of as we speak, and I think you'll see a press release on that within the next week or two at the absolute latest.
Keep chomping at the bit for it, just like you guys too.
Mm-hmm.
And maybe just to finish off that, the appendix, those little kind of photo shots of all those different projects, I love those. Could we go through those quickly, starting on slide 16?
Sure. So, what we have laid out in the appendix is just kind of a quick little overview on some of the more substantial assets that we hold. Not all of them, but a few of them. The first one is the Endeavor silver stream, and this is a silver stream off one of the longest operating lead zinc silver mines in Australia. It's been in production since 1983, and it's operated by CBH Resources. The second one on page 17 is, and these are all pictures of these assets themselves. So the second picture is a picture of the new Luika gold mine plant, and this is in Tanzania. It's in production, or it's operated by a publicly listed company on the London Exchange called Shanta Gold. And down the line here on 18, we've got a picture of the ZARUMA plant, or the ZARUMA Porterville mining plant. And the JOAQUIN picture on page 19 is actually a picture of the Manantial Espejo plant, which is an existing operation for Pan American. And what they're going to be doing is they're going to be mining the ore from JOAQUIN, specifically a high-grade deposit in JOAQUIN called La Morocha, and they're going to be trucking it to the Manantial Espejo mill. So this is existing infrastructure that they have, and it was a great kind of bolt-on asset that we think is going to be a great deal for them and a great royalty for us.
Keep those mills busy.
What was that?
I said keep those mills busy.
Yeah, exactly. I mean, when you've got a lot of infrastructure and a lot of capital tied up, it's a lot cheaper to buy something and continue to use this the infrastructure that they have, and then building a new one from scratch in another area. So Pan American, they're in my view, one of the best operators in the world. and you know, they make some pretty smart decisions typically, kind of around or extending the life of their operations. And yeah, just going down the Hoyle Pond extension royalty. You know, this is one of the earlier deals that we did. There's actually 2 transactions that we did, consolidating the full 2%. And this is not a royalty on the Hoyle Pond mine. It's the extension property where the deposit is extending at depth. So this mine as well has been in production since 1985, and as the deposit extends at depth to the northeast, it crosses a property line. And when it crosses that property line, that's the extension property. So it's not like a new mine. It's simply the existing deposit that extends at depth on that. And it's a very similar situation with the next page, which is the Timmins West royalty, and where that one also kind of extends, or we think has a high probability of extending onto the extension property where we now own a royalty on.
And if somebody wanted to dig deeper and try and pull out the costs for the Hoyle Pond extension or the Timmins West extension royalty, is that kind of in the management discussion analysis somewhere?
The costs in regards to for the mining companies, or the cost of kind of what we paid for it?
What you paid for it? Yeah,
so all of that is laid out in the press releases, which you can find on our website on those certain transactions. And also, you know, at a minimum, they're in the earlier year of management discussion and analysis. But I think the press releases would be probably the way to go, and you can find all those on our website.
On a ballpark number, the Hoyle Pond extension, was that $5 or $10 million cash, or was that a share? How much did you get that from Goldcorp for? Ballpark.
So we didn't buy it from Goldcorp. We didn't buy. So that's again kind of going back to our business, right? We did not buy that. Goldcorp would never sell us that royalty.
Yes, exactly.
You know, we bought it from a third-party holder, actually 2 third-party holders. The first transaction that we did was 2.5 million Canadian to lock up that asset, along with the Tahoe and then the DeSantis mine, which you know, used to be owned by Osisko as well, but now it's a Canadian gold miner. And we bought the other 1% for 1.5 million Canadian. So we locked up the 2% on that one for, you know, about 4 million. Obviously, some of that consideration is going to go to you know, those other assets as well. So you know, look, these are the types of kind of more unique type of transactions that you're going to get with Metalla, opposed to the, you know, traditional, you know, here is a check, build this mine. So there's a lot of different ways to do this business, and you know, you can be successful in you know, the various different parts of it, and it just kind of comes down, I think, to the discipline that the companies have to really kind of push forward their own model.
And the gold exemption, the 500,000 ounce gold exemption, is that a cumulative production number or something like that the extension has to reach before it starts paying the royalty, or what is that?
Exactly. So basically, it's a royalty holiday for the first 500,000 ounces that are produced on this extension. This mine last year did about 200,000 ounces of gold. It's averaged over the last 5 years, call it, you know, around 160,000 ounces of gold, and its average grade is running kind of right around a 1/2 ounce per ton. So it's the engine of the Porcupine Camp for Goldcorp. I mean, it's truly an incredible asset, and you know, we're happy to you know, take that you know, very calculated risk in regards to, you know, this potentially paying off in the future for our shareholders.
Yep, absolutely, great venture there, and to get it for $4 million or something like that too. Wow, good work. And the last one, AKASABA West royalty.
Yes, so this was a royalty that was previously owned by a company called Alexandria Minerals, and Alexandria Minerals got this royalty because they sold um, the AKASABA West property to Agnico for $5 million and retained a royalty. This royalty also has an exemption on it for the first 210,000 ounces. And you know what we kind of our view on this royalty is it's an exploration royalty for us, right? You know, we feel that most major companies, you know, when they buy assets, even if they're only $5 million assets in their backyard, you know, we don't think that they will buy it just to get 20,000 ounces of gold a year for 4 or 5 years, right? You know, our suspicion here is that, you know, Agnico probably, you know, at some point down the line will or may do some further exploration, and you know, anything additional that they find, you know, that's going to be you know, value for our shareholders, and we're happy to take risk there, you know, with an operator like Agnico in their backyard. You know, while you know they've committed money and time to build the project in the first place, you know, rather than, you know, taking exploration risk on something that's kind of completely greenfields.
Wow. Yeah.
And you know, if you look at some of the most valuable royalties that the majors hold in this space, you know, it's funny because some of the most valuable royalties that they own are ones that they spent less than $2 million on. So it just shows you that, you know, look, the royalty game is the long game, and you want to accumulate a lot of these types of assets that, you know, that give you the ability to be able to have, you know, very significant returns or upside returns for your shareholders. And you know, this kind of being right on the Cadillac Lardo fault, and you know, owned and operated by Agnico, you know, is definitely one that we, you know, wanted to put into our portfolio. So we, you know, we're happy with it. But again, it's, you know, it's a small little exploration, you know, royalty for us, and you know, we'd be happy to own another 10 of these like it.
Yeah, certainly. Well, and if you could get 10 of these things, that would be great. You know, the resource may look small now there, but you know, I just look at that um, cutout or buyback provision that allows Agnico to buy back 1% of the royalty for $7 million. That's it's it seems like a relatively large amount to buy back 1% based on the current resource size. Anyways, you know, it would seem to indicate that there's some confidence in the counterparties that there's a lot more there potentially.
Yeah, I mean, and you know, again, a lot of that is kind of where, you know, where they are in the world, and you know, a number of other factors. But you know, these you know, these are the types of things that we want to put into the portfolio. You know, we think that, you know, 2-3 years from now, there's going to be a lot of these, and not just kind of similar to this one, but similar to the rest of the portfolio. And you know, we think it'll be a great way to really give investors and shareholders, you know, a great exposure to a rising metal price environment. And you know, one thing to note on our, specifically going back to our dividend policy, and I just have a couple minutes here left, is that, you know, our early investors that invested on our you know, our first round that we did at the 30-cent level are already getting at their cost basis a yield in the high single digits, and we think, you know, that'll go you know, through probably 10% within the next year. And we think that, you know, investors that can pick up, we're our yield right now is about 2 and change%. And, you know, we think investors that can pick up a cost basis today will likely have something much higher in the next couple of years as they look back.
And I see you joining there in September 2016, right around that 30-cent level. What a great time to get involved with the company.
Yes, yeah, it was the start of a new company there. So we're we're definitely happy to continue to push this thing along, and we think there are even better times in front of us.
Thank you very much for taking the time to introduce it to me today. Let's say goodbye to everybody there.
Yeah, thank you. And if you have any other questions, you can find a lot of information on our website. It's www.metallaroyalty.com.
Great. Thank you very much, Brett. Goodbye.
Thank you. Bye.